Imagine having a personal mentor who hands you the exact blueprint for building billions of dollars in wealth. For Warren Buffett, that mentor was Benjamin Graham, the legendary author of The Intelligent Investor. In today's video, I'll break down 5 powerful rules Warren Buffett learned from Graham, rules that you and I can use to grow our money wisely, avoid common mistakes, and maybe, just maybe, create our own path to financial freedom. Stay with me until the end, because rule number 5 is the one Buffett calls the most life-changing lesson of his career. Rule 1. Treat stocks as ownership in a business. Most people see stocks as numbers moving up and down on a screen. But Benjamin Graham taught Buffett something radical. A stock is not just a piece of paper. It's ownership in a real business. Think about it. When you buy shares of Apple, you're not just buying a ticker symbol. You're literally a partial owner of one of the biggest tech companies in the world. This mindset completely changes how you invest. Instead of asking, will this stock go up tomorrow? You start asking, well, I want to own this business for 10 years. Buffett applied this rule when he invested in Coca-Cola in 1988. He wasn't trying to flip the stock for quick gains. He thought, people will still be drinking Coca-Cola a decade from now. That's exactly why Berkshire Hathaway still owns billions in Coke shares today. For beginners, the takeaway is simple. Before buying any stock, think like a business owner. Would you be proud to own the business? Does it have products people can't live without? If yes, then it's worth considering for the long haul. Rule 2. The margin of safety principle. This is the cornerstone of Graham's philosophy. A margin of safety means you buy investments for less than they're truly worth, giving yourself a buffer against mistakes and market downturns. Buffett describes it like this. If you build a bridge that can hold 10,000 pounds, you never drive more than 7,000 pounds across it. That's the margin of safety. For example, if a company is worth $100 per share, but the market panic pushes its price down to $70, you've got a built-in cushion. Even if things go wrong, you didn't pay full price. Buffett used this rule when he bought Washington Post shares in the 1970s. The company was worth hundreds of millions, but the market priced it at just $80 million. Buffett saw his margin of safety, and years later, that investment paid off enormously. So, before you buy, ask yourself, am I getting this at a discount to its real value? If yes, you're investing the Buffett way. Rule 3. Mr. Market is your partner, not your enemy. One of the most brilliant ideas in The Intelligent Investor is the metaphor of Mr. Market. Graham told readers to imagine that every day, Mr. Market comes knocking at your door, offering to buy your stocks or sell you his. Some days he's euphoric and offers crazy high prices. Other days he's depressed and sells dirt cheap. Here's the lesson. Mr. Market's mood swings shouldn't dictate your emotions. Instead, you should take advantage of his irrationality. Buffett mastered this rule. In 2008, during the financial crisis, Mr. Market was depressed, selling great companies for pennies. Buffett stepped in, invested billions in Goldman Sachs and General Electric, and those deals brought Berkshire massive profits. For us, it means this: don't panic when a market crashes. Don't get greedy when it soars. Stay calm, stay rational, and use Mr. Market's emotions to your advantage. Rule 4. Focus on long-term value, not short-term noise. Benjamin Graham warned investors against speculation. He said the stock market in the short term is a voting machine, but in the long term, it's a weighing machine. What does that mean? In the short run, stocks rise and fall based on popularity, hype, or panic. But in the long run, the true weight of the business, its earnings, cash flow, and durability, determine its real value. Warren Buffett lives by this. He ignores daily headlines, market gossip, and short-term drama. Instead, he looks at whether a company can consistently generate profits over decades. Take his investment in American Express. In the 1960s, the company faced a huge scandal and the stock tanked. Most investors fled. Buffett looked deeper and realized that people weren't going to stop using their Amex cards. He invested heavily, and that decision became one of his biggest long-term wins. For you, the takeaway is this: don't chase fads. Focus on companies with strong fundamentals, proven track records, and the ability to grow over years, not just weeks. Rule 5. Be a defensive investor, not a speculator. The final rule is perhaps the most important. Graham encouraged investors to be defensive. That doesn't mean being timid. It means protecting yourself from unnecessary risks. A defensive investor builds a portfolio that balances risk and reward, avoids overtrading, and keeps emotions in check. Warren Buffett took this to heart. He famously said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." This rule is why Buffett holds massive cash reserves. He'd rather wait patiently for the right opportunity than gamble recklessly. It's why he avoids complicated, speculative investments and sticks to businesses he understands. And this is something beginners can do too. Focus on steady growth, diversify your portfolio, and don't risk money you can't afford to lose. Being defensive doesn't mean you won't grow. It means you'll stay in the game long enough to let compounding work its magic. These 5 rules shaped Warren Buffett into one of the greatest investors of all time. But the beauty is, they're not just for billionaires. They're for anyone willing to be patient, disciplined, and thoughtful with their money. So let me ask you, which of these 5 rules resonates with you the most? Is it treating stocks like businesses? Using a margin of safety? Or maybe ignoring Mr. Market's wild mood swings? Share your thoughts in the comments. I'd love to hear your perspective. And if you found this breakdown valuable, don't forget to hit that like button, subscribe to the channel, and turn on the notification bell so you never miss future uploads. We've got a lot more deep dives on wealth, investing, and financial freedom coming your way. Remember, wealth isn't built overnight. It's built brick by brick with patience, wisdom, and the right rules to guide you. Thanks for watching, and I'll see you in the next one.